So good news is bad news for mortgage rates this morning. The US announced that their employment numbers were actually double market forecasts. They created 497,000 jobs in the month of June. That's the highest that we've seen since March of 2022. Majority of that sector is in the hospitality and service sector. In fact, 232,000 jobs were created in those fields. People are spending. They're taking vacations. So the US yields went up exponentially this morning. We saw a 10 basis points increase in the yields in the US, which affects our Canadian bonds, and they went up 12 basis points. What does this do for interest rates? We're going to see an increase in fixed rates. We're seeing inflation coming down, but it's a very sticky time to get to the goal of 2% when we're dealing with consumer spending, government spending, and a very high employment number. So until those numbers start moving down, it's going to be higher interest rates right now. It's going to be a bit of a harder landing, I feel, with inflation, and we could potentially see a 0.25% increase on July 12th when the Bank of Canada is announced whether they're going to increase or not. And then we will more than likely see the US federal rate increase a quarter, if not a half a point. So stay tuned. Lots of news coming up on this. Tomorrow we're going to have the Canadian employment numbers as well, and we'll continue on with the conversation.